Most people think retirement comes down to one number, which is how big their portfolio is, how strong their balance sheets look. And in real life, what determines peace in retirement is cash flow, predictable income that you can rely on month after month after month. And so throughout the rest of this video, I'm going to walk you through a real planning conversation that shows why that's true and how life insurance can play a powerful role even when someone doesn't technically need additional income. Now, many people assume that life insurance only makes sense if you're young or if you're trying to replace income or if you don't already have retirement assets. And if you're in your late 50s or maybe early 60s without millions upon millions saved up, it's easy to feel like you can be kind of behind. And that's exactly how my client felt in our conversations. Now, I would say, though, that framing is a little incomplete. And I would even say in many cases, it can be just flat out wrong, depending on the puzzle pieces at play. Now, this conversation was with a gentleman in his early 60s planning to retire in about 3 to 4 years or so. And his liquid net worth is about $400,000. Very respectable, not massive, but very respectable. Now, what's important to understand, though, is his guaranteed income. He has pension income projected to pay out somewhere between $3,000 to $4,000 per month. Plus, he has a very meaningful Social Security income later on that'll pay maybe closer to $4,000 or even up to $6,000 a month if he waits until he's about 67. And so from a cash flow perspective, he's actually in a very strong position, especially given the fact that he's a very frugal person and doesn't spend a whole lot. Now, we started to map out what happens if nothing changes. And so we used a planning software and we modeled his pension, his projected Social Security, deferred compensation, savings, and all of that. And what happens with a lot of people, including him in this particular case, is that everything's really flowing through market-based accounts outside of the guaranteed income. And then withdrawals are just going to kind of happen as needed. And I would say on paper that works and it can work pretty well. Now, the risk shows up when markets are down. Income still has to come from somewhere, whether it's a good year, whether it's a bad year. And that's where this idea of sequence of returns risk quietly enters the pictures. And so I'd encourage you to reference videos that we recorded, whether on this channel or the Better World channel, with Todd Langford, Dr. Wade Pfau, Dr. Tom Wall. And these are interviews that our founder Caleb did with them. But in short, and this is Demetrius's definition, sequence of returns risk is all about the risk of stock market returns not being in your favor at the right time. And it's a huge risk for those who need income to live in retirement. Now, this is also where guaranteed income really works in my client's favor. So someone receiving $6,000 per month in guaranteed income is in a very different position than someone with a large portfolio and no guarantees. So for example, if a retiree is receiving $6,000 per month between pension and Social Security, that's roughly about $72,000 a year. Now, using a simple 4% rule, that's the equivalent of having a $1.8 million investment portfolio that will be needed in order to create the same level of income. Now, again, I just did the basic math, 72,000 divided by 4%, and that's how I came up with that $1.8 million. The guaranteed income, that layer there, reduces the pressure everywhere else in the plan because you know what's coming in. Now, after the initial conversation that he and I had, the next step wasn't necessarily an illustration, at least not quite yet. What I actually did was I recorded a screen share video and I walked him through the numbers visually. This is how we tend to work with clients. And so we started with a phone call, kind of got understanding of the goals and cash flow. We modeled out some scenarios and then again, I recorded a walkthrough so that the client can kind of see the logic without feeling like rushed into anything in particular. And so after that, we exchanged a few follow-up emails, we refined some assumptions, and then we came back together for a deeper strategy meeting. So what I want to walk you through right now is exactly what I shared with him in the initial screen share video that I sent out to him. Hey, it's Demetrius. Just wanted to pause the video real quick because if you're a high earning professional, an entrepreneur, someone who just wants more control over your money, we offer something called a clarity call. It's a one-on-one conversation where we walk you through how an overfunded whole life insurance policy could help you build safe, liquid, tax advantage foundation for your wealth. There's no pressure, no fluff, no hype. Just real clarity on whether this strategy is right for you. So go ahead and click the link in the description or the tag comment below, and we'll walk you through exactly how we can help you. Back to the video. So what I walked my client through was a couple of different scenarios. The first scenario was basically kind of the path that he's on right now. And the second scenario was a path that incorporated the use of life insurance. And so what we're seeing here is a present value of $400,000. So present at the time of retirement. And then we're looking at a time horizon of 20 years. So we're looking at from age 65 to age 85. Okay. In terms of the rate of return, we're actually using historical rates of return, just basically using the S&P 500 starting in year 1973. Literally any year could technically be used, but I wanted to specifically highlight what would happen if in the event the first year, maybe even the second year of retirement resulted in him having some negative rates of return years and the impact that that has on the rest of your retirement if that were to happen. And so then we got the guaranteed income here as well. So what I did here under government income, I've just listed $30,000 per year. I didn't even adjust it for inflation or anything like that, just kind of kept it simple. And then what I also did here when it comes to the pension income, I put in that $42,000 per year, which is about $3,500 per month, okay? And so there's the total desired income of $110,000. Again, this gentleman in particular doesn't live like an extremely lavish, fancy life by any stretch of the imagination. He considers, again, himself extremely frugal. And so if we scroll down to the chart here, what we're seeing here is that of the $110,000 of income, $72,000 of it is already taken care of, okay? Then there's this desired income or deficiency surplus, right? So it's showing $38,000. So what this is saying is that this $38,000, which is allowing us to get up to this $110,000, is coming out of the market-based assets with his deferred compensation. This is the additional income that he may want to take out for whatever he may need or want while in retirement. And so in that first year, again, he starts off with a balance of $400,000, and then he takes out $38,000. The balance after all of that is $362, and then the market tanked by 14.67%. And so he lost about $53,000. So that brought his balance at the end of the first year to $308,895. And then in the second year, what happened was there's another loss in the market, another dip in the market of over 26%. And so just from a pure dollars perspective, he lost over $71,000. And so in the matter of 2 years, he lost a little bit over half the value that he started with in this particular case, looking at $199,622 by the end of that second year. And so it's really just going to show you that he'll be able to be just fine until about year 11. And then in the 12th year, he's looking in the negative. And I think in reality, what would happen is he probably wouldn't continue to withdraw $38,000 because there wouldn't be $38,000 anymore. But it's just kind of going to show you the money that he has and the strategy that he's looking to potentially implement himself may not be the best strategy after all. So next, what I want to do is show him something a little bit different. So in this particular case, we're actually starting off with a smaller sum, right? We're being very conservative with regards to this. So we're starting off at a smaller number, $50,000 less, okay? But the total desired income is the same. The income from Social Security is the same. The income from the pension is also the same, okay? And again, I'm not adjusting for inflation. But in this particular case, I wanted to account for sequence of returns risk. So what I'm specifically saying is I turned on this button here. It says sequence defense. So pretty much what this is saying is if I have saved up in another place an additional source of money, how might that impact the income that I'm able to take out throughout the rest of my retirement years? So in this particular case, we're showing $200,000 of non-market source of money. In other words, income that is not correlated with the stock market by any stretch of the imagination. So we just so happen to be using life insurance cash values in this particular case, okay? So what I actually did specifically was shown a different amount of income coming out in the years following negative years in the market, right? And the reason I did that was because when you're taking income from a life insurance policy, and 99.9% of the time, you're going to be able to receive that income tax-free. And so if he's usually needing to take an additional $38,000, right, just kind of keeping things simple, well, if we account for just a modest 20% tax rate, well, then the net amount of income that he'll need to take out of the life insurance policy is not $38,000, but it's closer to $30,400. So that's the reason why I did that. And you'll notice the sequence defense, again, is happening the years following a negative year in the market, okay? And so what we find here is that by the end of a 20-year span, we're looking at $360,378, when before we were looking at a negative balance of negative $328,639. And so it just kind of goes to show the power of utilizing something within the portfolio that is not correlated with the market in order to produce a greater level of future cash flow while in retirement. So in short, the role of the policy was to act as a stabilizer within the overall portfolio, even though he wasn't always going to need that money year after year after year. We just wanted to show what it would look like in an example. And so again, in down market years, instead of forcing withdrawals from investments, there's another place to pull from while those stock market investments recover. And then in good years, if he needs some additional capital, he can always tap into his investments, or he always, again, has options. So nothing's too aggressive, nothing's too speculative. We're just giving him optionality. And this is also where an important clarification needs to be made as well. I just want to say this, okay? 60 years old is not too old to start a life insurance policy. And I would just say that, period, point blank. Like, whether it makes sense has nothing to do necessarily with age and everything to do with the purpose of getting the policy, right? So if this policy needed to become his primary source of retirement income in just like 3 or 4 years, it probably just wouldn't work. But as a supplement, as a volatility buffer, as a source of additional capital, as a legacy asset, it absolutely can. And so I say that just as an aside because context matters, design matters, and the intent matters as well. So again, we kind of went back and forth, had a lot of correspondence. And once the strategy made sense conceptually, then we looked at an actual life insurance policy illustration. And the one that I'm going to show you here isn't necessarily the one that we've landed on, because we're actually in the middle of figuring out what's going to be best for him still as I record this video. But the policy was designed to complement his pension, complement his Social Security, not replace them, not replace his other deferred compensation assets he had either. Right? Again, the goal was stable, accessible capital and a meaningful death benefit for his family. And the funding of the policy that we'll take a look at here came directly from just redirecting dollars he was already saving, not changing his lifestyle at all. All right, so here's the policy that we looked at initially. He's saving about $30,000 per year. We kind of went a little bit more granular in terms of the specificity of where we're going to get those dollars from. But $27,600 is what we showed going into the policy every single year. And so what we're seeing here is that there's pretty high levels of liquidity even at the end of age 62, right? So we're seeing that it looks pretty good. And then even from a standpoint of when this policy breaks even, we're seeing that that happens here in the 7th year. So in the 7th year, $193,200 had been contributed to the policy by that particular point in time. And then in terms of total cash value, at that point in time, he has $196,203. Now, mind you, his death benefit started off at about $354,000. And by the 7th year, it is now ballooned up to $555,000 by that particular point in time. And so what we're seeing illustrated here, like I told him, was that this $9,545, that so happens to be that minimum required premium that he's more than comfortable contributing on an annual basis. The only thing here is he has the option to offset this premium with his dividends and cash value if he wants to. Therefore, cash value continues to grow in those years, maybe just not as aggressively, as well as the death benefit also would continue to grow, which again is ultimately what he's looking to accomplish by having a policy. It knocks out multiple birds with one stone of having the cash value growth, having the stability within the portfolio, and leaving a death benefit to his heirs at the time of his passing. So the moral of the story is this right here, okay? You don't necessarily need millions upon millions of dollars to retire well and to retire comfortably. Reliable income, which is what my client had, is something that matters more than anything else. It matters more than big numbers on a sheet of paper, right? Pension, Social Security, other forms of guaranteed income are incredibly, incredibly powerful. And I think they deserve more respect than they normally do. And life insurance, when it's purpose dependent, not age dependent, meaning that there's an intent behind getting the policy and not worrying about necessarily the age and am I too old for it, matters a lot. And so even later in life, just like my client, it can be a very strong supplement when structured properly and when aligned with your particular goals. So if you're within a few years of retirement and you want help kind of thinking through this, thinking through your cash flow, your guarantees, whether life insurance fits into the situation, my team and I walk through this just about every day. So feel free to schedule a call with us. The link should be in the description and we'll be more than happy to help. So thanks for watching. We'll see you in the next one.